When you're just starting out, rent, utility bills, debt payments, and groceries may appear to be all you can afford. It's time to start investing once you've mastered budgeting for those monthly expenses and set aside at least a little cash in an emergency fund. The difficult aspect is deciding what to invest in and how much to put in it. It can be intimidating to invest for the first time, but here are 5 simple investment rules to get you started. Hey everyone, welcome back to our channel. In this video, we will be talking about 5 effective and simple rules for beginners to invest. Before we start, make sure to hit the subscribe button and turn on the notification bell. Done? Let's get started. There are a lot of great investors, but very few investors have the track record of Peter Lynch. He ran the Fidelity Magellan Fund between 1977 and 1990. During that time, he beat the markets by a huge margin, as he outpaced the S&P 500 11 out of the 13 years, averaging over 29% average annual return. This means $1,000 invested the day Lynch took over the Magellan Fund would have been worth $28,000 when he quit. He does this by following certain principles and rules while investing. Let's have a look at each one of them. Rule number 1. Get started straight away. Begin immediately. Even if it's only £1 each day or week, you'll see your money grow quickly, no matter how tiny the sum is. This is due to the notion of compound interest, which is both simple and essential. Another way to think about compound interest is that you get paid interest on the interest you got paid, and then you get paid interest on that interest, and before long, the interest you received is greater than the money you put in. Assume you deposit £100 in the bank. In the first year, if the interest rate is 5%, you will earn £5 in interest. As a result, instead of £100, you now have £105. The next time you receive interest, it will be calculated on both your original £100 and on the interest you got, resulting in a total of £5.25. You now have £110.25 in your account, and it will continue to increase until the interest portion is greater than the original cash you put in the bank. If you did that for another 25 years at the same interest rate, your £100 would have grown to £338.64. Consider saving £100 every year at the same interest rate. You'll have saved £2,500 over the course of 25 years, but you'll have earned an additional £2,273 in interest, nearly double the amount that you saved. It's similar to a snowball running downhill and accumulating snow. The snowball is much larger than it was at the start by the time it reaches the bottom. Compound interest works in the same way. It accumulates on itself. The more time you have to save, the better. You would have accumulated £9,032 after 35 years of saving £100 every year, plus £5,532 in interest. Rule number 2. Do not choose stocks. First, let's take a look at the stock market. Companies sell shares of their company on the stock market to raise capital. These shares are offered in a limited amount and are publicly traded. Someone who has a share must be selling it if someone wants to buy it. The price of a firm's shares is determined by supply and demand, which is frequently influenced by how well the company is performing or predicted to do. Now that we're all on the same page, let's get to the meat of why the world's finest investors all agree on one thing. Don't pick and invest in individual stocks. The Observer newspaper pitted experts Justin Urquhart Stewart of 7 Investment Management, Paul Cavanagh of Killick & Co., and Schroders wealth manager Andy Brow against students from John Warner School in Hoddesdon, Hertfordshire, and Orlando, a ginger cat who chose stocks by throwing his favorite toy mouse on a grid of numbers assigned to different companies in 2012. And guess what? Orlando came out on top. Humans are incapable of foreseeing the future. Stock selection is difficult. No one has a crystal ball to tell which company's stocks will soar and which will plummet. Every stock picker in every region of the country would be a billionaire if there was a simple technique to accurately anticipate which shares will outperform the rest. There are legions of people going broke for every billionaire produced by the stock market. You may be asking why people invest when the stock market is so volatile and dangerous. Because the ideal way to invest is through an investment fund that buys shares in a variety of firms on behalf of its investors. This is the greatest option. The fund will shield you from some of the risks associated with picking bad stock. Some equities will rise in value while others will fall in value. Active funds are those in which the manager chooses which stocks to acquire based on research, knowledge, and experience. There's also the index tracker to consider. The stocks of an index, such as the FTSE 100, are purchased as a group by an index tracker. Even if there is some danger, the stock market has always gone higher in the long run. This means that if your portfolio follows the broader stock market, even if some particular stocks fall in value, your investments will grow over time. Rule number 3. Maintain a minimal cost structure. Your investments may be performing well, but if the cost of managing them is excessive, the long-term returns are reduced. Costs for active funds are higher, as are fees for a financial advisor and fees for the investment platform where your investments are held. All of these expenses can pile up and reduce your earnings, so it's important to keep track of them. Assume your investment yields a 2% annual rate of return. Your returns will be wiped away if your advisor, investment platform, and fund charge you 2% per year. Those fees can spiral out of control, which is the polar opposite of compound interest. Consider two persons who invest £1,000 per month for the next 30 years. One pays 1.5% in fees while the other pays 0.5%. Although a 1% difference may not appear to be significant, after 30 years, the first person has amassed a portfolio of £387,430, while the second has amassed a portfolio worth of £450,741. This is a massive disparity of £63,212. Inquire about the impact of costs on your investments if you hire an advisor. Check what you're getting charged for the platform and the fund charges if you manage your own assets. Rule number 4. Diversify your portfolio. Investing in stocks and bonds carries a certain amount of risk. It's a good idea to diversify your portfolio, which translates to don't put all your eggs in one basket. What if you invested everything you had in blockbusters? We discussed why stock picking never works and why mutual funds do. Smart investors diversify their risk by purchasing mutual funds that provide exposure to a variety of markets and asset classes. If you diversify your investments over many various businesses and countries, such as pharmaceuticals, industrials, the internet, green energy, and so on, you will be protected from any ups and downs in any portion of your portfolio. We humans prefer to invest in what we know and trust, but rather than a bunch of UK equity funds all invested in the same underlying investments, you can diversify by investing in UK, Europe, US, and Asia-Pacific equity funds. For example, spreading risk and taking advantage of different economic factors in each of those markets. Cash, bond, and mixed asset funds should all be used to diversify your portfolio. Rule number 5. Block out the background noise. Emotions is the enemy of investment, and it's easy to get upset when the markets are up and down. Attempting to time the market has historically resulted in worse returns. Don't be swayed by market analysts who encourage you to buy or sell. Instead, have the courage to adhere to your long-term strategy. Investors that seek for high performance or flee from low performance are doomed. The difference between smart and bad investors is that the former can shut out the background noise. You'd have to agree that the global financial crisis of 2008 was far from trivial. And you're right, such events can have a significant influence on investors and have a long-term impact on the economy. Attempting to time the market, on the other hand, has historically resulted in worse returns. Don't be fooled by CNBC's entertainers who cry buy or sell. Have the determination to stick to your plan in both good and bad circumstances. Investors that seek out high returns or avoid losses are doomed. The discipline to shut out the noise and stick it out for the long haul is what separates smart investors from terrible investors. However, those who panicked and withdrew their money to preserve their investments in 2008 crystallized their losses and missed out on the next 10 years of spectacular development. In that time, the stock market has gained by 84%. That's a lot to miss out on. Smart investors keep their money in the markets. Did you find this video informative or helpful? Let us know in the comment section below. Make sure to subscribe so you don't miss out on any of my future videos. And don't forget to like and share.